Alrighty, folks. Well, welcome to my office. As you can see, it's my bed where I do all of my work. There's my computer somewhere over there with a little flower supply hanging out of it. What we're doing today is my very first YouTube ad. So let's shrink me and put me next to my text. That's good enough. All right, what we're doing today is my very first YouTube ad. Well, I'm not a pro at advertising or marketing. I am a pro at creating open source free code that helps people everywhere make money. On YouTube, can you find me? Absolutely you can. You can find a playlist tutorial teaching you how to code your own bot to trade on interactive brokers. One of the world's largest API-enabled traditional stocks, equities, and derivatives trading platforms. Another playlist focuses on how you can automatically perform retail arbitrage, buying low on Amazon or eBay and selling high on the other. And there's countless others. On GitHub, you can find me. This is all free and open source. There's over 100 repositories. There's one that deals with, there's actually a couple that deal with Quant Connect bots to algorithmically trade news or social sentiment in stocks and options. Another one deals with sports betting bots to exploit the disagreements among bookies and automatically perform sure bets, winning some winning some money no matter the outcome of the match. Now, I said I wasn't a pro, but there's one there that deals with ad network arbitrage scripts to automatically buy web visitors low on redirect.com and sell them high on zeropark.com, maintaining a guaranteed return of 3 times your money back. That's 300% on every click or dollar spent. That's actually my most popular repository. There's countless, like I said, there's hundreds. Well, there's just over 100, I guess. There's countless others. But what we're doing today, I'm going to introduce you to a brand new trending set of technologies that revolutionize the way derivatives, which is just they're based on the underlying action. So let's say you have Apple and it's trading, and then you have your options and your futures and all that stuff. Your options and your futures are your derivatives, and then your underlying symbol, that's your Apple. So this new technology revolutionizes the way that derivatives are traded, giving us the ultimate opportunity to make a sure bet pure arbitrage profits with as much volume as we can throw at it. What's more is that I'll introduce you to my day job, capitalizing on newer, more accurate, and truly a black box of not reproducible type of artificial intelligence that can predict how markets will move more often than not. How do I find out what this new and novel technology is? Send an email to my personal address. And guys, I guarantee you, I'm going to respond to everybody, and I'm going to give you the attention you deserve. I'm going to treat you as a person, and you're not a number. There's no automated responses. There's no garbage. There's no, and I mean, I know I sound like I'm a salesperson and stuff, but really, I'm just a developer. I do this for fun. I got headhunted on my birthday last year by my company, and he basically said, "Hey, I noticed your bots. Do you want to help us make some bots, and we'll make bots together, and it'd be a fun project." This is my hobby, guys, and I like to do it. I like to help people out, so I will treat you as a person. There's no automating the good old human touch. Futures trading in traditional markets, what does it look like? Well, you trade at leverage, which means that basically if you put $1 in, then you can trade up to $100 by borrowing with the exchange of the platform you're on. So basically, if you were to trade $1 and it goes up $1, it's now $2. Sorry, if you were to trade your dollar and the underlying instrument went up by 1%, say, that means that you have 1% of profit. But if you were to trade your $1 at leverage, at 10x leverage, that means that you're trading with 10 times that amount. You're not trading with $10. If it goes up by 1%, you've now made 10 cents instead of 1 cent, basically. So you make 10 times as much back than you would have trading without leverage, or 100 times, or whatever the leverage might be that you're willing to risk trading at. Now, with futures on traditional markets, the minimum is actually $10,000 to make an order, which is just outrageous. I have no idea why they did that. I have no idea what the logic is behind that. Now, there are mini and micro lots you can buy for the most popular stocks and stuff, which are less than that. But basically, if you're looking to play with futures on traditional markets, it's a very high requirement. It's a pay-to-play thing. There's limited ways to make sure bet income or arbitrage income, because there's just limited ways you can put them together and figure out ways to protect your investment and to hedge and stuff. And what a hedge is, we'll get into that in a sec. But what you can do on traditional futures is what's called cash and carry futures arbitrage. It's actually a very popular subject. You can search that on the internet. A guy, I forget his name, but he does Khan Academy is what it's called. It's a free training video resource for everybody. It's actually on YouTube too. They do an awesome video on cash and carry futures arbitrage. They do a few videos on arbitrage actually. And if you don't know what arbitrage is, like I said above, buying low and selling high, and getting guaranteed results from your clicks and your dollars. That's all arbitrage. Basically, it's the process of, I mean, just look up Khan Academy arbitrage introduction, and he's got an awesome video on it. He uses apples. Basically, he says that if you can buy apples downtown for $2 a piece, and you know you can sell them uptown for $3 a piece, why wouldn't you buy 10,000, right? Anyway, so here's an example of cash and carry futures arbitrage. You say lean pigs are trading, and that's actually a thing you can buy on traditional futures, which is the ability to buy or sell pigs in the future. Let's say they're trading at $7,000 on the spot market or without leverage, and say they're trading at $7,050, which is $50 more on the futures market, expiring 3 months from now. We could long or buy the spot market, and then we could short the futures market. By the time 3 months rolls around, regardless of what happened to the price of lean pigs, we would have earned that calculation of 0.714% profit, which would be this calculation 34.272% annualized, which means that if I was to put $100 in there, I'd have $134 after a year if I repeated that process every 3 months. And that's called annual percentage yield, or APY. At 10x leverage, that would have been 5x that amount, as half your leverage was in the underlying and also half in the futures, and that would be 171.36%. So like I said, trading at leverage just amplifies your results. Notice it also amplifies your losses, but we'll get into that at the end of the video. So 171, you just basically, just by using leverage, you just 5x'd your returns there. That's nearly doubling your money every year. So these new and novel markets that I've found, and actually a lot of people have found them, they're probably not even that new to you as a concept, and you probably heard of some of them and stuff, but I'm just going to introduce them to you in a brand new way and describe these ways that we can make money that not really anybody gets into. I mean, I've done it for years now. I've gone over riskless and risk-free ways to make money on options and stuff. It's all over HackerNoon, it's all over Medium, it's all over the internet. Just search my name, it's there. Anyway, we're still trading leverage. Most of these markets allow you to go up to like 100x leverage or 20x leverage or whatever. So 20 times your money, 100 times your money, and 100 times your results, and 100 or 20 times your results, or whatever. You can trade with as little as $1. Now remember up here I said that you needed at least $10,000 to trade these traditional futures markets. With these futures markets, you need only $1. They created an all-new futures contract, or like a kind of futures, like the pigs that expire 3 months from now. There's also pigs that expire 6 months from now and 9 months from now, which basically means that in 6 or 3 or 9 months you could buy or sell your pigs at that point for the price that you specified now. Now they created this all-new futures contract that has no expiry. It's a brand new thing that was enabled by technology. Instead of future premiums, so basically what happens is we know that the futures premiums are going to go to they're going to converge. So in that example with the pigs I gave you, the pigs, the price $7,050 is absolutely going to become $7,000 or whatever the spot price is in the future. They're going to converge. They're going to approach each other more or less over time until they're exactly equal on expiry day. Now with these new contracts, instead of futures premiums, they charge and rebate a fee. So if I mean, it depends on if the price wants, if they want the price to go up or down. So let's say this contract is trading too high, they would actually make the people that are buying it pay a fee every 8 hours or 1 hour or whatever the exchange says. They would pay a fee to the guys that are shorting or selling that contract. So basically, over time, it gives them incentive to bring the price back to what it should be, what it normally would be, or what the underlying price is. So they charge and rebate a fee to and from users, and they don't even keep a piece of that fee. It goes to and from users, meaning you can actually exploit that and make that fee, and that's your primary objective by trading these contracts, to bring price in line with the underlying. Given as many as 3 to 4 contracts, like, 3 months from now, 6 months from now, 9 months from now in this new contract, for the same underlying, like Apple, we can perfectly hedge, which means that we can buy and sell an equal amount. It actually says here in the next one. Or no, it doesn't. It means we can buy or sell an equal amount of one of these contracts in the other contract. We can long and short, so that basically when it goes up or down, and I'll actually explain this in a second, but basically when the price of the underlying goes up or down, one of our positions will go up and the other one will go down equally so that it nets out to zero. So this allows sure bet arbitrage from buying a contract low and selling the other high, and then waiting for the prices to eventually approach each other until they become equal, which locks in profits slowly and guaranteed over time. By the way, guys, if I'm going too fast, I do talk too fast. I used to work in call centers. I worked for Microsoft. I worked for the guys that are now called BlackBerry. Everybody used to tell me to slow down. I'm going too fast. Nobody can understand me. Well, the good thing about YouTube is you can watch it again. I think you can slow me down in the settings. Or all of this text that I'm reading now is actually on my website, which you can get by clicking on this ad. If you just click right now, anywhere on the screen, it's going to bring you to my website where you can read all this stuff that I'm reading right now, which absolutely paraphrases the points that I'm trying to make. And then at the bottom is my email where you can get a hold of me, and I will tell you what this new and novel tech is. I will release the secret. It's free. I'm not even going to charge you. I'm not charging for any of this stuff except for the subscriptions for the AI bot, just because it's so much better, and we'll get into the results in a minute. Anyway, alternatively, depending on the opportunity, which one is greater, we can exploit the market conditions that allow us to collect those fees every 8 hours while remaining perfectly hedged or without any risk. In either case, having equal positions short and long means that price movement of the underlying doesn't affect our returns. Only the arbitrage or fee opportunities that we've measured and chosen here, one of these is going to be higher than the other, compared and then optimized for best yields, will give us riskless profits. So, what's another thing that I can offer? We can offer automated algorithmic robot trading, and all algorithmic means is that it trades by an algorithm, and it is a robot, which is why I threw that word in there. So it trades up to hundreds of times a second. I don't know if any equities trader or fund manager or anybody can trade more than even if they have like a 2-click system. Some of them do have 2-click systems. They've thought that really well out. But I don't think they can trade hundreds of times a second, 24 hours a day, 365 days a year. And these automated algorithmic robot trading bots can. They can trade while you sleep, like I said, all the time. Or you're on vacation, or you're with your kids, or you're cooking food, or whatever you like to do. Read a book. People should read more books, I think. Everybody should read more books. You can trade without emotion, and that's actually very important because every single trader on the market, on any market, will tell you that the very first time they lost money, or when they lost the most money when they were first learning how to trade, was because they got caught up in their own emotions. They were chasing a loss. They were just chasing a win. If they chase a win or chase a loss, they're going to lose money. It always follows strict relative risk rules. So that's another thing that humans are really bad at doing, is that you'll change your risk how averse you are to risk over time based on the results that you're getting. So if you're trying to win back a loss, and this is especially true among gamblers, but if you're trying to win back a loss, you will change your order size. You will change all the parameters that you have and all the variables to be more risky as you go. And that's another way that people lose money. And that's another way that bots don't lose money. It also reacts to changing market conditions in the blink of an eye. Look at that. I said I'm instead of in. Why would I do that? Let's change that before we publish this. Yippity dippity doo, yippity dippity doo. It's a good thing people proofread, right? I'm the blink of an eye. In. And you see, I'm using WordPress. This is not a very advanced site. I'm not a designer. Excuse the site, by the way. And excuse the lack of color or imagery or anything. It's just very plain. I removed the ads for you guys because I'm going to put a YouTube ad to get you guys to click on this thing. I didn't want you to be barraged with ads that I make money off of then, because that's not very nice. So yeah, I removed the ads. Anyway, so the new and novel tech that we're talking about, the other new and novel tech, I mean, all of the new and novel tech does the stuff that we just talked about in the last couple sections here. But the new and novel tech that's even more exciting is our artificial intelligence, our patent-pending neuroevolutionary artificial intelligence. It trades smarter. It trades smarter than people can. And how it does that? It uses novel search, allowing it to think from the least possible solution inwards, which is exactly the opposite of how humans think. Now, that's important because That's how it's a black box. And a black box in financial terms is something that can't be reproduced. It's a secret. It's a trade secret that it's kind of like a trade secret in trading. That people can't figure out. That people can't replicate. That it's an edge they can't take away. It's something you have over the market, that is yours, and we're sharing that with you for a very low price. It's $35 a month right now. And I'll show you the results here in a second. It's fantastic. It's outstanding. For the first 100 users, it's $35 a month. Now, when humans think about a problem, if I was to say, how do I code something, or how do I write this article, or how do I make this website, or how do I create this YouTube video, I'm going to say to myself, well, I probably have like 5 options that I can think of off the top of my head when I think about it for 10 seconds. And then out of those options, this one's the most likely to succeed. This is probably what's going to work. I'm going to do this thing. If it doesn't work, I'll move on to the next one, which is going to take a little bit more time to see if I can do or not do, and then move on to the next one, or one that was going to work. Now, with AI, they can think a lot faster than humans can. They can compare all of the options a lot faster than humans can. And then what they can do is they can actually choose the least likely answer or solution, and then see if it works, and if it doesn't, move inwards from there. This is not how people think, and this is one of the reasons that it's a black box, why it's not reproducible, and it just moves inwards. So when it finds the solution that does work but was very unlikely, and then makes it compete against other populations in that genome. So basically, we have all these populations. So say we have squirrels, say we have rats, say we have whatever other vermin you want, and they're all competing for the food, for the land or whatever. Say we're all competing, and then all of a sudden you get a lot of mammals come from that, and I don't know what happens, but one of those becomes the successful champion. One of those becomes the human race among these vermin. They can think, they can do stuff, they can save the world, they can kill the world, they can do whatever they want. They can elect people as president. They can converse. They can have conversations. They can ponder their own existence. What is it? Cogito ergo sum. Anyway, point is, one of these will become the champion of all of those populations, and then what happens is evolution happens, and basically, you based on the success of how you did in that run, or that generation. And the successful ones will go on to reproduce, and the non-successful ones won't, and they will become extinct, those populations. And sometimes random chance comes to play in genetic algorithms and in genetics in real life, and people will mutate, or populations will mutate, and completely random. Like how did eyes become to exist, man? How did evolution figure out that we needed to, like, vision and stuff with mutation, man? It's some random animal was born with an eye that worked, and it survived and managed to make lots more babies because it could see. And that's how eyes came about in all of these animals that have eyes. Eyes are obviously very important to successful procreation. Anyway, the evolutionary algos evolve based on the success of the generation and sometimes random mutation. And populations compete with the existing champion algorithm, like humanity, like I'm sure other races will eventually compete with humanity, or maybe mutants, and it's already happening. So they're going to compete with an existing champion algorithm while losers become extinct. And it's also, just to point out, I'm not really an expert on the AI that we use, and I mean our AI developer is much more well versed in this stuff. I can do it justice when I talk about it, but the words he uses in common parlance and in common English, he thinks is common English. I just can't even grasp how this stuff works. But the thing is, I do know from what he says, and what he's most proud of, is that this combination of AI technology is one of the most resilient against overfitting. What overfitting is when you take a training set of data, like let's say you're training on trading from 2009 to trade in 2010. And then you test it against the 2010 data, and then you go trading in 2011. Either way, if you train your AI with too much data, then it's going to become too used to the inputs, and it's going to not react well to new data, or new market types, or new market conditions. And this AI technology actually is designed to not do that. It's designed to become more refined and more accurate with more data. What are the other perks of trading with me? Anyone owning a factory that makes fidgets, widgets, or wackadoodles has to tie up all their money and count on the revenues, maybe not getting their money back easily. That's called illiquid capital. It's not liquid, it's illiquid. Here, your funds, here with me, your funds are in your account. I don't even have access to it. And you cash out on the profit or any amount of the capital, any amount of money you can take out at any time. These are liquid funds. That means that you have access to it. It's like water. You can move it around, right? We have access to your account through API keys, which stands for Application Programming Interface. Basically, we have a program that talks to the exchanges programs, and they trade on your behalf. And you can restrict those or revoke them at any time, and we will no longer have access. So your funds are absolutely yours. We have no access to do stuff if you don't give us access. And think of the APRs I mentioned. So actually, I forgot to go and do some other stuff here while I was talking about this. So remember the sure bet arbitrage from buying a contract low and selling it high? This is called cash and carry arbitrage with futures premiums. So I have a couple of scripts on my GitHub that you can actually go and look at right now. They're on a recent GitHub, and one of them has to do with futures premium arbitrage, which is this guy here. This is one of the files inside of that repository. And I ran it just a minute ago when I was about to create this video, so I'd already have the output for you guys. And I mean, I can show you the code. This is not made up. Here's the code here. It does stuff. Anyway, I could run it again if I wanted to. Let's run one of these again. Whoops. No, I can't run this one again. I'll run the other one again. There's me. All right, run it again. So look at that. I'm running a program that I wrote, and it compares all of these different opportunities for you. So we're actually going to get different results than we did a minute ago. What happened to my output? All right, so the one we're going to talk about now is this one, which is the futures premiums arbitrage opportunities on one of these exchanges that the new and novel tech has enabled to rise to power and become really popular. There's a lot of volume. There's a lot of taker volume and a lot of maker volume, and there's not very much opportunity unless you know what you're doing. Now, there's a lot of output here, but basically what it's saying is that the average opportunity that it found that was over the threshold that we wanted is over 100% APR. That's more than double your money every year. The average opportunity that would actually trade is only one of them. Right now there's only one of them. The average opportunity that we would actually trade out of those is 251% of your money, 251% APR. That's doubling your money every 145 days. Was that 4 or 5 months? 5 months, yeah. So that's that. The next one here was the fees that we earned from bringing the price back down to the underlying price for these new contracts that were created. And in that scenario, I actually compared 5 different exchanges, 5 different providers where you can buy and sell these new and novel techs. So basically, on one of them, it's about 300%. On another one, it's about 300%, just over 300%. On one of them, it's 1,400%. That's 15 times your money back in a year. That's absolutely ridiculous. And then I was talking here about our AI trader. Well, our AR trader is right here. So here's a section, a run that we had of the bot with test funds. We had about $35,000 on this bot trading these new and novel technologies using our artificial intelligence. So we ran it from the 24th of August to the end of the 3rd of September until the 4th of September. And during this time, you can see it went up, it went down, it went up, it went down, almost where it started. It went down to 3.82% returns after, I don't know, 7-8 days, and then it shot up. The AI chose a trend. It found a trend, it exploited that trend, and it ended at 36%, just over 36%. And like, what is that? That's a week, that's 2 weeks. Either way, the next section of what I was reading is the summary. In our spot check of these free scripts I have on my GitHub and the AI that we have for a subscription, at the time of recording this video, found with futures cash and carry arbitrage on one exchange, we saw opportunities as high as 251% annual percentage yield. With newly created contracts in our new and novel tech, we can earn as much as 1,486% APY on one exchange, Two others were just above and just below 300% APY. Remember, that's 4 times your money back in a year. Basically, I could say to you, hey, you can keep your money, you can withdraw it at any time. Give us access. If you want to, you can revoke it. Give us access, and we'll double that in, what is that, like 3 months? We'll double that in 3 months. And then what's going to, no, sorry, it's 4 months, because it's 300%. It's actually tripling the money every year. So we'll double that every 4 months. After 8 months, you'll have double your money, and you can take out your original $1,000 or whatever, and then you can just leave the $1,000 as there and let it double every 3 or 4 months or whatever it is. I'm forgetting what I'm talking about now. Sorry, guys. It's a very long day. So, our patent pending AI had a recent run from August 24th to September 3rd that earned a whopping 36% over 8 days. And if you follow the calculation, that's 1,642.5% annual percentage yield. That's, what is that? That's 6, 12, 18. I don't know. Hold on. What's 60? Hold on. Let's figure it out. 16.5 divided by 3. That's 5.5 times as much as we saw in the last example, where we had the money doubling every 3 or 4 months. And just do the math there yourselves. Either way, we should mention that no matter how good the AI is, no matter how assured these profits are, we cannot and will not imply or assure that we can predict the future. There's lots of stuff that could go wrong, guys. There's been examples of whole, economies shambling and failing and stuff. There's always a worst case scenario where you might lose all of your money. This does not constitute financial advice. Trading at leverage is extremely risky, and like I said, you might lose all of your funds. Only risk what you can afford to lose. How do I get started? Send me an email to my personal email. You can find this email all over the internet. I have it registered for stuff. I have it listed on stuff and stuff. It's been my email for years. I think it was an invite-only email to Gmail back before they started being public. I'll try my best to respond to all inquiries within 2 business days, just because I am busy, and there's probably going to be a lot of inquiries. And be sure to subscribe to my YouTube for more videos. Click this link to go to my YouTube. It brings you straight here to this Done YouTube here, where you'll see this video. We cannot... You can peruse my GitHub at your leisure to find some gems and other repositories. There are a whole bunch there, and some of them are sorely in need of love and attention. You can click here to go to my GitHub. You can find the GitHubs that I was talking about. This is actually my personal blog. It's not even a landing page, really. It's just a page on my blog. You can find other posts there. You can find me on HackerNoon. You can find me on Medium. The point is, guys, get a hold of me, and we will discuss further details. All right, then. Thanks very much. Bye. Click on this video, by the way, to go to my website and read that stuff and get my email. Bye-bye.